Hey Bowtie Nation, Joseph Hogg here. Thank you for joining us for another Monday market update, 9 a.m. every Monday morning. Get you ready for the week, stocks to watch, economic news you need to see, and we are at new all-time closing highs. Stocks in the S&P 500 closed at 48.39 Friday, its first closing high since January of 2022. It wasn't without making investors sweat it out, though, over the last couple of weeks, in which big 1% moves have become the rule rather than the exception. The market index tumbled more than 2% in the first week of the year alone, and that VIX Volatility Index, the market's fear gauge, spiked 20% just in the last week to its highest since last November. That kind of volatility might not be over as earnings ramp up, but fortunately, there are 3 ways you can make more money and reduce the risk in your stocks when stock market fear heats up. I'm going to show you those 3 ways. Stick around. After that, we'll do our Monday market update, the stocks I'm watching this week, and the economic news you need to see. But first, I also want to highlight a special offer from one of the research tools I use, Seeking Alpha Premium. I've used Premium Access for more than 7 years to get analysis and ideas, and more importantly, to make sure I'm getting the bull and bear case for a stock. You'll find pre-built stock screeners for top-rated stocks, dividend yields, and growth stocks, and you'll be able to sit in on a company's earnings reports to get that inside information. Look for the link I'll leave in the description, and you'll be able to try Premium Access risk-free for 7 days. If you like it, that link is also going to give you a promo code for $50 off the regular price, so make sure you check that out. Back to our main topic though, because stocks broke their highs last week, but not without a spike in volatility and some sleepless nights for investors. After surging 16% in the 2 months from last October, stocks tumbled 2% in the first week of the year and struggled to hit that high everyone wanted. I still believe this year produces even higher prices, especially as we get into that Fed rate cutting cycle, but the ups and downs can kill your motivation to invest and stick with your favorite stocks. Fortunately, there are 3 ways to win that stock market game when fear causes price swings. First, understand volatility is just how much the market or a stock moves up or down in a given period, a gauge of that stock market craziness. The Volatility Index, or the VIX, is the market's expectation for volatility over the next month, so how crazy investors believe stock prices will be. So that VIX Volatility Index is based on futures prices. It gives us a representation of how much fear there is in the market going forward. While you can't invest directly in the Volatility Index, you can invest indirectly through futures, options, and ETFs, betting whether that actual volatility is going to be higher or lower than it's expected, as well as using it to reduce the risk in your own portfolio. That's because since the VIX Volatility Index, that fear gauge is historically inversely correlated with the stock market. That means when stocks fall, the VIX typically goes up and vice versa. You can use it to hedge some of your bets in stocks. I'll show you the data behind that later, but using some of these investments can help you offset any short-term losses in your stocks with gains in these investments. And the first way is going to be buying or selling calls and puts on the VIX index itself. For example, if you're worried that the market might give back some of its recent gains, then you could buy these February 14 calls on the VIX here at about $1.77 each. These options were trading as high as $2.66 each just last week on the 17th when that VIX spiked to 15 on the index. If market fear jumps again, that money you make on these call options can help offset your stock losses. But there are some important differences you need to understand here between stock options, regular stock options, and these VIX options. VIX options do not trade on the VIX price itself, but on futures or the market's expectations of where the VIX is going to be at expiration. Okay, it's kind of a subtle and confusing difference with stock options, but it means option prices aren't going to follow that index exactly like they would a regular stock option. VIX options are also cash settled. Okay, you can't get shares in the VIX like you would with stocks. You buy a call option on a stock that exercises and you're going to get shares of that stock. You don't get that with the VIX. It's going to be cash settled before expiration. Now, VIX options normally expire on a Wednesday, the last trading day being the Tuesday before. So understand you're going to need to close out their positions before that. Now, the way I use volatility and market fear is through options on individual stocks. You see, volatility is directly related to the options premiums in stocks. As volatility goes up and the prices jump around more, then the odds that those options are going to be in or out of the money go up as well. And the options prices you're going to get are going to help guide your strategy for when to buy or sell those options. An example here will make this clear. Here, shares of one of my favorite stocks, SoFi Technologies, ticker SOFI, have plunged 25% since late December. So along with that general market fear, the volatility in SoFi is through the roof, and options premiums have gone with it. That makes it a very good opportunity to sell some of those options. Since those premiums have gone up, the premium that you're going to collect by selling those options have gone up with it. And it's presenting long-term investors like myself in the stock with what I believe is a win-win scenario. If we go here to the options on Yahoo Finance, we can scroll down, go to the January 2025 options, so a little bit longer term options here. Here we see I can buy shares for $7.49 each and scroll down and simultaneously sell these call options with a $10 strike price for $1.44 each. Now for new options investors, there's a lot to unpack there, but it means I own the shares because I bought it at $7.49, but have sold another investor the right to buy them from me. That call option, I sold them the call option at a price of $10 each over the next year. Now I get that $1.44 a share now. The price of the call options I've sold to another investor, they're giving me $1.44 right now. And if the shares jump to $10 or more over the period, that investor is going to use that call option, buy the shares from me at $10 each. But think about what we have here. The volatility on this stock has gone up so much and taken that option premium up so high with it that I'm lowering my cost of shares to just $6.05 each. That's the $7.49 I paid for the shares minus $1.44 I get from selling those call options. I'm getting nearly a 20% discount on the current price, okay? If the stock does go up to $10 or beyond, I think it's a very good chance that it does, especially over the long term. I see this at a $12, $15 stock easily. If it goes up at that point, $10 where that other investor is going to buy them from me, divided by 605, I'm getting a 65% return in just a year. If the stock does stay under that $10 each, I keep the shares. I keep that $1.44 option premium, that 20% cash premium I collected on the shares. And the third way to benefit from volatility is a new ETF we've talked about on the channel, the Simplify Volatility Premium ETF, ticker SVOL, with its 16% dividend yield. Now, what I like here is the SVOL really isn't taking a directional bet here. It's simply saying that the market expectations for volatility are typically higher than they are actual come out to be. Now, shorting those expectations, so selling futures contracts against the VIX, which is what the SVOL is doing here, is a way to capture that fear premium in the market. And this strategy is backed up by research, testing VIX futures shorting from 2005 through 2015. Rolling that short contract over each month was profitable in 8 of the 11 years, with an average monthly return of 0.7% and a total return of 118% over that period. Now, the biggest selling point for me, though, is that this is a totally different asset class. That premium for shorting the volatility index is reliable and robust. And again, the VIX has historically a negative correlation with stocks. When stocks go up, the VIX goes down and vice versa. That correlation here is a negative 0.84, which is very strong and means using a volatility strategy along with your stock portfolio is a great way to reduce risk. You've got your stock portfolio that goes up when the stock market goes up, but you've also got an investment that goes up when stocks go down. Now, the Simplify Volatility Premium ETF shouldn't be confused with 2 other Invesco funds, the S&P High Dividend Low Volatility, ticker SPHD, which invests in dividend stocks with historically low volatility, or the S&P Low Volatility ETF, the SPLV, which just invests in the 100 S&P 500 stocks with the lowest volatility. But with these 3 ideas, you don't have to just sit there when market fear jumps. You can stay in your favorite stocks long-term and use these short-term opportunities to win that fear game and reduce the risk in your portfolio. I want to turn it over to some of the stocks I'm watching this week. Here first, Netflix, ticker NFLX, going to be reporting its earnings after the bell on Tuesday. And while the shares really haven't participated in that 2-month rally, I like the stock here as my favorite long-term play on streaming media. In fact, I'm going to share details of why Netflix could be the last streamer standing in a video tomorrow. Make sure you check that out. Netflix's advantage in low-cost overseas production has really helped it to continue to roll out that binge-worthy content, while a lot of the other streaming services have scaled back. Netflix also makes far more revenue per user than other platforms and sports a profitability nearly twice its competitors. Sales last quarter are expected up 11%, while the earnings of $2.22 a share would be more than 18 times improvement over the same quarter last year, where it had a lot of write-downs pull down those earnings per share. Crown Castle, ticker CCI, is going to be reporting its earnings on Wednesday and is up 20% since highlighting this stock in a video early October. Real estate stocks continue to be one of my favorite contrarian themes right now. While commercial property prices are likely going to feel a little bit more pain this year, now is the time you want to be accumulating these REITs before those interest rate cuts by the Fed turn that sector around. Tesla, ticker TSLA, is also going to be reporting its earnings on Tuesday after Elon Musk's power play for more control last week. The one-time world's richest man is going to have to prove why he deserves that 25% voting control when he only owns 13% of the shares right now. So knowing how Musk loves to please a crowd, I'd put good money on him trying to make some hefty promises for future growth. That said, revenue is expected up just 5.2% from last year's quarter, and earnings are forecast lower to 74 cents a share versus the $1.19 reported in Q4 of 2022. The recent slump in shares, though, has taken Tesla back to its price of November 2020 and some rare valuation multiples for long-term investors. Right now it's trading at 7.7 times on a price to sales basis. You can see here the average over the last year. That is a very good discount over some of these 11 times, 8 times price to sales ratio. American Airlines, ticker AAL, is going to be reporting its earnings Thursday after a rough week for airline stocks. Airlines underperformed last week when a U.S. district judge blocked the proposed takeover of Spirit Airlines, that's ticker SAVE, by JetBlue Airways, ticker JBLU, saying that the combination would be anti-competitive. Now, valuations may look attractive in some of these stocks. For example, American Airlines here trades for just 5.8 times on a price-to-earnings basis. Very cheap here, but I'd caution you to look further into these financial statements, especially the cash flow. Free cash flow for many of the airlines has been hit or miss over the last few years, and balance sheets are loaded up to the brink of debt. American alone owes more than $41 billion in long-term debt against just $10 billion in balance sheet cash and a market value of just $9 billion. Now that debt is going to become even more expensive as the airlines refinance at higher rates over the next coming years, and if cash flow doesn't improve, it's going to spell trouble. Intel Corporation, ticker INTC, is also going to report Thursday here after the stock has rallied 50% since last October. While earnings here are expected to rebound to $1.86 per share on 12% revenue growth over the year to come, the story here is much more about AI and the laptop story than anything Intel is really doing right. Understand that the enthusiasm behind AI is lifting all chip stocks, and the market is expecting a boom in PC demand over the next year as consumers really upgrade their old devices with AI capabilities. Intel will undeniably benefit from these trends, but I would go with stronger competitors in the themes like NVIDIA, AMD, and HP. Showing you that big picture idea with the sectorspiders.com sector tracker, great free resource here on the internet over the last 5 days. We can see that despite that broader strength, only 5 of the 11 stock sectors actually closed higher last week, with overweight in technology stocks and that strong performance in that sector really pulling the S&P 500 index up. Typical risk-on sectors like communication services, tech, and consumer discretionary did well. Interest rate related sectors like utilities, real estate, and staples underperformed though, as those higher interest rates once again threatened to pull investors out of dividend stocks and into safer bond or money market investments. Stocks in the energy sector are now down 12% over the last 3 months, the only sector in the red for that period. In fact, shares of favorites like Chevron, ticker CVX, are down 15%, while Devon Energy, ticker DVN, has fallen 17%, but are still posting very strong cash flows. We can see here in the cash flow statement for Chevron alone produced over $20 billion in free cash flow last year. That was more than enough to pay the $11 billion in dividends and spending down its $19 billion cash stockpile. It was also able to buy back over $15 billion in share and pay down $4 billion in debt. Now, yes, with lower cash flow from lower oil prices, the company won't be quite as generous in buying back its own shares this year, but will still have plenty of cash flow left to grow that dividend. In fact, on data from 2021, we can see most major oil companies are dividend break even between $50 and $60 per barrel on crude oil. Record oil production in the US, Brazil, and Canada is expected to push supply up 1.25 million barrels per day. That's BPD this year to 103.5 million barrels per day, but demand is expected to increase at an equivalent rate according to the IEA. We can talk about outlier events like an escalation of events in the Middle East or a recession and what that would do to oil prices up and down, but the base case right now is for very strong support of oil around $70 a barrel. It's not to say that oil stocks can't fall further down or kind of hover around their current prices, but combined with dividends, those long-term returns should be very good from here. It has been a weak start to earnings season, putting investors on the edge. Just 10% of the companies in the S&P 500 have reported though, and most of that has been from the financial sector, with a lot of the major banks taking big write-downs, so that's likely skewing the results lower. I still expect the rest of the market to report strong earnings, beat these expectations we see here for earnings growth. Right now we do see that earnings growth year over year in Q4 for last year is negative 1.7%, so the market does expect the stocks in the S&P 500 to report negative earnings growth for that quarter. I think they're going to beat that. I think it's going to come out positive and surprise a lot of investors, really keep that bull market alive. Look for that link in the description. Try out Seeking Alpha Premium for 7 days risk-free and get your coupon for $50 off. Or click on the video to the right for the 7 best dividend stocks you can buy for 2024. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.